Good afternoon, ladies and gentlemen. The top main focus of today's presentation, the fiscal situation in South Africa as we start approaching the medium-term budget policy statement, which is due to be delivered on the 1st of November. And why it's so relevant is because it is having such an important impact on the rand, obviously inflation expectations, interest rate expectations, and obviously it will cover a lot of the domestic economic outlook as well. Let me start off by focusing on what's happening in the economy right now. The good news is that if you look back 6-9 months ago, there was a real risk that the South African economy would go into recession. We were saying, wow, we're already under stage 6 load shedding, and we are now heading for winter. And during winter, the demand for electricity typically increases sharply. And so we headed for stage 8 or stage 10. And so people like myself were forecasting negative growth for 2023. As things have turned out, load shedding has not been quite as intense as we thought it would be, and so the economic outlook has improved, relatively speaking. We're not saying we're facing a great economic situation, but we're talking about marginally positive growth. Typically, growth forecasts have been revised upwards by ourselves, for example, from 0.1% to 0.9% now. 0.9% is really appalling, but it's still better than 0.1%. The Reserve Bank has revised its forecast up from 0.3 to 0.8%. The IMF last week revised its forecast up from 0.3 to 0.9%. So you can see there's been a relative improvement, partly also because we've now had statistical outcomes, which we saw in the first quarter. The economy grew by 0.4% quarter on quarter, and the second quarter by 0.6%. Positive growth, not negative growth. So that's given us a little bit of encouragement. There are other factors that I'm going to go through in terms of what has resulted in a slightly better outcome than what we anticipated. And some of those are sources of encouragement. But let me just deal briefly with the electricity situation. You can see from here how the intensity of load shedding has actually improved after this incredible spike during 2022 and the first part of 2023, and how it's come down. Now, some of it is due to Eskom managing to improve maintenance on some of the power stations, and that has basically given us a little bit of hope. Yesterday, the Minister of Electricity announced indeed that one of the units of Kusile has now come back on stream. 4 of those units out of 6 have been offline because of maintenance work, because there were huge problems last year. One of those 4 has now come back on stream. Each of those units is capable of producing capacity generation of about 800 megawatts, which is almost 1 stage worth of electricity outage. And then by the end of the year, the hope is that 3 more of those stages, the remaining 3, will come back on stream. And then next year, there is hope that one of the 2 units of the Kuiberg nuclear power station in the Western Cape will also come back on stream. So there is real hope that by next year, we will have, purely from existing capacity that we know about, another 3,000 to 4,000 megawatts of generating capacity. On top of that, we know that there's been a lot of investment that I'm going to refer to in a moment in renewable energy projects, and some of those, hopefully, from the private sector will start coming on stream later this year. But the real factor that has contributed towards the easing of the electricity situation is that we are actually not using as much electricity as we thought we would. The demand for electricity has fallen by 7-8% year on year, partly mainly as a result of the installation of solar panels and the usage of generators by a lot of businesses. On a separate project, I've been involved in the last couple of days on writing up a report on a survey that Grant Thornton did on surveying businesses and what they expect. And suddenly they're forecasting a reduction in their energy costs after having seen a big increase. And clearly that is a reflection of the fact that many of them have now installed ways of finding alternative energy sources. So that's all fairly good news. We can't guarantee that we will, and quite clearly load shedding is going to be ongoing for some time yet, but we are at least talking about stage 2 or stage 4, not stage 6, 8 or 10 that we were fearing. So that's actually good news. The second really positive development is, as you can see here, again, off an incredibly low base, but let's be grateful for it. Gross fixed capital formation, or what we used to call fixed investment in buildings, plant, machinery, transport equipment and the like, has actually started picking up again, and by more than many people had forecast. A lot of that has to do with renewable energy projects. Some of it also has had to do with just generally improving IT, and a lot of businesses are going into artificial intelligence to bypass the hassle of having to employ people to do the investment. We're short of skills, so we go for more technologically intensive stuff. And what is quite positive from a longer term point of view is, if you can see in this graph, the blue line is gross fixed capital formation. The black line is consumer spending. And you can see that for most of the past decade, one of the reasons why the South African economy has not collapsed in the face of this dreadful decline in capital investment is the fact that people carried on spending. The middle class was still gainfully employed and carried on spending. And so we had a situation where consumer spending tended to carry on increasing, but capital investment was falling. Now, anyone with a little bit of insight will know that that is not a very good and sustainable solution for longer term investment, because if you continue consuming and not plowing back into producing the goods and services that you need in the longer term, then you're headed for for low economic growth. What we've seen more recently is consumer spending is starting to level off in the face of high interest rates, but we've seen this fairly substantial improvement back again in fixed capital formation. So from a structural point of view, that is an important improvement in the state of the economy, driven mainly by the private sector. And that's suddenly the message is coming across. If you think of all the hassle and the nonsense that we've been having to put up with in South Africa in the face of load shedding and the collapse of our SOEs, etc., it's amazing that we're still recording positive growth. In many other countries, you would have had a collapse in the economy 5–10% or so. That hasn't happened, partly because the private sector just keeps going along, the old man river. And that is really quite encouraging. Also encouraging is more recent. We're also seeing that even with our SOEs now, there's been an element of renewed investment taking place. Where has that investment been focused on? As I mentioned, new equipment. We've seen very sharp increase in investment in machinery and equipment. The construction sector, building and civil engineering, however, has carried on lagging. And unfortunately, we're not going to reap the full benefits of replenishment of our infrastructure until such time as we see the construction segment, building and construction, starting to pick up. Unfortunately, there's been an excess capacity in the face of a lot of emigration taking place and in the wake of the COVID-19 crisis that rendered a lot of buildings obsolete. But also, we are seeing that hopefully we might start seeing a little bit of a pickup of that once interest rates begin to decline. But it's early days. The other big drawback has been the construction mafia and the sabotage and criminal activity that's been holding back a lot of that civil engineering. The third factor that is, I think, provides a bit of hope is inventories. There's been a dramatic decline in the level of inventories that businesses hold, which is quite good for profitability, by the way. But it hit an incredible low point a couple of years ago. And a lot of that has to do, obviously, with IT and the ability to generate systems that can start managing stock levels a lot better. But it does provide one a hope that, in fact, inventories have been run down to such an extent that we're bound to see a little bit of growth emanating from renewed investment in inventories. And in fact, in the second quarter, we saw an improvement of around 16.7% year on year, first quarter 7.5%. That's also providing a little bit of an uptick in economic activity. On the other hand, where are we losing out? The more obvious area. With a rise in interest rates, people's financial position has come under strain, and we're starting to see the one sector that had been doing reasonably well, retail sales, starting to tail off, consumer spending starting to tail off, car sales also starting to tail off. Until recently, they were doing amazingly well, but now we're starting to see a slowdown, and that's not surprising. People's financial conditions are coming under strain. We've also seen a fall-off in credit demand due to this rise in debt servicing costs from below 7% of disposable income to nearly 9% of disposable income, because after all, your prime overdraft rate has gone up from 7% to 11.75% in the last 2 years. And you can see until last year, people were trying to make up for the impact of higher interest rates by borrowing more, but that is now starting to fall off somewhat. And so we end up with a situation where we're forecasting longer term, a gradual improvement in economic growth to around 2% by 2026. But within that, note that the consumer sector is likely to be very, very sluggish. Last year, it grew by 2.5%. The year before, post-COVID, by over 5%. But we're looking at no more than 1% growth in consumer spending, the retail sector. So from a stock selection point of view, you've got to bear that in mind. On the other side, we see a little more resilience in fixed capital formation. This is positive from a longer term point of view, but it just does give you a perspective of where the growth in the economy is likely to reside. The other negative factor that we have encountered has been a deterioration in our terms of trade. In 2021-22, the economy benefited enormously from a sharp rise in certain commodity prices, the most important being coal, palladium, and rhodium and iridium. Those have now fallen back quite sharply, and so we suddenly running back into a current account deficit, and that's been one of the important factors that has weighed on the value of the rand, because obviously the bigger your current account deficit, the more you need to attract foreign capital to prevent your currency from depreciating. And the second big negative is, of course, that as those commodity prices have fallen, so it has started impacting negatively on the profits of a lot of the relevant mining companies, and we have seen as a consequence a reduction in revenue collections. But the government is still under a lot of pressure to keep spending, especially ahead of the general election next year. And the consequence has been a sharp fall-off in the budget deficit. During COVID, of course, the economic activity collapsed, and we had a dramatic fall-off in revenue. Then we had the commodities boom, especially coal, that saw a nice recovery, but now we're going back down. And this graph also shows you the extent to which this poses a huge challenge now. These are the budget deficits that the government budgeted for in February, and look at where we're headed right now. So there is a real risk of that budget deficit expanding enormously, and that pushing up, forcing the government to borrow more, pushing up the public debt to GDP ratio. This graph also highlights this. You can see how you had this sudden spike in revenue collections in 2022, and since then it's just flattened off, and yet expenditure ahead of the general election has been going on and on. And one of the big, well, there are three big areas of expenditure that we're concerned about. The first is the need to carry on forking out 40 to 50 billion rand each year to fund the payment of 350 rand a month to 8.5 million people who don't have access to any form of income other than that cash in order to survive. The second big area is forking out an extra 60 billion rand to fund salary increases for public servants. And the third big area of concern is, of course, bailing out state-owned enterprises. There is a fourth one that I haven't gone into because I don't believe it's just not feasible, and that is what is called the National Health Insurance Scheme. That would cost hundreds of billions of rands. It's all talk. It's just not feasible unless we decide to print the money to do so. What is our savior, fortunately, is that if you look at where the government has borrowed money in the past 20 years, it's done so in a very prudent manner so that the maturity spectrum of the bonds that have been issued have been over a long period of time. So that unlike many other countries that are in the same situation, we are not going to face a sudden massive credit crunch of running out of money. There's been a lot of talk all the time about, we're going to run out of money. Yeah, it's a nice euphemism. There's no way that any government actually runs out of money, because a government can always borrow more to fund its whatever cash it needs, or it can print the money to do so. The problem with either of those alternatives is that, yes, you can borrow more money, and you'll get, as a government, people to buy up your bonds, but they'll be more and more demanding in terms of the premium interest rate that they demand. So, and that, of course, is what we have seen most recently in terms of the huge increase in our debt servicing costs as long-term interest rates have risen. And government is now having to pay almost 20% of all the taxes that it collects simply to pay the interest on what it has borrowed in the past. A decade ago, or 2009, that figure was only 8%. So in other words, 12% of government spending capacity from taxes has been eroded simply in order to redirect funding towards more interest payments. And when you get some of these populist economists saying, this austerity is ridiculous, we don't have to do it, we can always borrow still more, why is the government not doing so? They just don't get it, that is one of the outcomes. The other thing, it's quite a busy chart, but simply the message here is that one of the big dangers is that the government tends to always overestimate how much the economy is going to grow and how many taxes it's going to collect. Fortunately, in 2021, that was not a case, because suddenly we had this bonanza from higher commodity prices, but there is this danger all the time of overestimating the growth of the economy. Funnily enough, this year now, if we're talking about 0.9%, it's not, that's exactly what the National Treasury had forecast back in February, so it's not such a serious situation. But nonetheless, this drop-off in revenue that I showed you earlier translates into the fact that according to our model, public debt to GDP ratio is headed up to 85% of GDP by 2026, compared with the forecast of it peaking at 74% of GDP. For people who don't understand, well, so what? Well, these are just numbers. And they will then point to the fact that the United States has got a public debt level of 120% of GDP. Italy's is 150% of GDP. Japan's is over 200% of GDP. So why should the government here be complaining about 70 or 80% of GDP? The answer is, unfortunately, because we're an emerging market and investors overseas have a perverse view of South Africa, they penalize us in demanding a much higher premium to buy our bonds than they do to buy American government bonds, which are seen as, gilt. And so the difference is that our long-term interest rates are 12 and 13%. In America, those long-term interest rates are below 5%. So we have to pay 2.5 times as much to borrow money as they do with the same amount of debt. This graph simply shows you how corporate income tax revenue has started falling off very sharply. And this poses a huge problem and challenge now leading up to the medium-term budget policy statement. How is the National Treasury going to get away with finding the money, how is it going to make sure that we don't overborrow? Firstly, it's been talking about raising the rate of VAT by 2%. So if we go from 15 to 17% VAT rate, we can, in the short term, collect an extra 54 billion rand, which goes all the way towards funding us continuing with this special social relief for distress grant of doling out 350 million rand 350 rand a month to 8-9 million people. The second point is for public servant wages that would be facilitated. But the real challenge is that if we were to raise the VAT rate, COSATU and SACP and all the populist elements within the economy would cry blue murder because, of course, VAT is a very pernicious tax on those who don't earn any income, because effectively those who don't earn income pay some tax whenever they buy food or anything and have to pay VAT. So it's a very, very hot topic that could generate quite a lot of unrest within the country if we're not careful. So what is the government planning to do? And I think we're going to see some of this emerging in 3 weeks' time when Godongwana delivers the MTBPS. Freezing on hiring public servant wages, cutting back on wasteful expenditure, and we're talking about, he's talking about shutting down, doing away with programs to shut down visible policing, the Oceans program, doing away with that. The one I laugh about is saving 1.2 billion rand by not allowing foreign diplomats to buy alcohol duty-free. Can you imagine how much that concession has been exploited by these various African diplomats and others? I better not sound too racist in that, but really. Doing away with the Rooiwal defense program, other defense cuts, and freezing new capital projects until March 2024, which is also quite negative. But these are, little by little, that's what they're going to try. And it's quite difficult in an election year. But you heard President Ramaphosa yesterday basically telling the ANC's NEC, guys, forget it. We have no option but to do that. If he doesn't stick to that, then we're off to the races. Sell your rands, buy foreign assets, whatever you can do in a big, big way. What is very interesting is that if you look at the budget that was presented in February, there was this interesting line item called unallocated reserve of 35.7 billion in 24-25 and 44.5 billion in 25-26. So the government knew to some extent that it would have to compromise with the public sector unions with its wage, giving them a big wage hike. And so to some extent, it won't need to exceed its borrowing requirement to the extent that people had anticipated, because it's basically put that cushion already into the existing budget. Nonetheless, You can see how this, they have just given investors a huge skrik as they see the government revenues falling and the need for more and more borrowings that has sent our long-term interest rates back up to the highs that we saw, above the highs that we saw during the COVID crisis. And what's exacerbated the situation is that in order to fund that extra borrowing requirement, the government has had to increase the amount of money that is borrowing on auction. As you can see, the weekly auctions have increased to 16 billion rand per week from levels of around 12 billion rand per week, putting upward strain on interest rates. And at the same time, foreigners especially have been less and less willing to buy our bonds because of they getting scared and they see a train smash developing. And with all the story about load shedding and other things, they've just reduced the amount that they're willing to pay on our government bonds. Now, of course, there are other aspects that influence the situation. As they reduce their alacrity to buy South African government bonds, so of course that has put downward pressure on the rand, or upward pressure on the dollar vis-a-vis the rand. We've gone from 13.5 rand to the dollar to 19 and plus to the dollar 2-3 years, and yet our inflation rate has been lower than that of the United States. So the real value of the rand has weakened enormously because of the fears surrounding this debt crunch that South Africa could face. Having said that, we've got to a situation now where the rand is close to the lows that it reached after Nenegate, after the global financial crisis, and after 9/11. And there were special reasons with each of those as to why the rand got so cheap. This graph basically measures the purchasing power of the currency. In other words, how much can you buy with the rands overseas in real terms? And right now, the rand is very, very cheap. So to a large extent, a lot of the bad news has already been discounted. If you want to be optimistic, if you're a technical analyst, I find this fascinating. Look at this cycle. 8 years, 8 years, 8 years. Aha. So be careful of being too negative on the rand. This suggests that something positive could actually materialize in the coming year or so. And the one factor that plays on my mind, of course, is the general election. And you could have some changes in the political landscape. You know, if you were a pessimist, you say, oh, the ANC will get into alliance with the EFF and that's a disaster and so on. Not necessarily. You could have a completely new realignment where you suddenly find politicians coming in with a lot of influence, politicians who are far more geared towards trying to do things for the betterment of the country rather than a lot of what's been happening for the last few years where so many of the politicians are in it just to fill their pockets. So don't get too pessimistic about the rand. In fact, our forecast is that we're headed towards 18-19 to the rand. That's the new norm for quite a while. I wouldn't, unless, of course, the ANC were to abandon this fiscal rectitude and say we're going to print the money to pay our way. What does this all mean for inflation? Obviously, if the rand stabilizes, it's quite good for the inflation rate. The good news is you can see inflation has come down from 7.8 all the way to below 5% most recently, even excluding food and fuel, which were the big factors underlying the spike in inflation. The core inflation rate has also come down back to below 5%, which is closer to the midpoint of the 3 to 6% inflation target. And the Reserve Bank effectively is focusing on 4.5% as its inflation target. Food inflation has come down very sharply from 14.5% to 8%. And the fuel inflation rate, everyone keeps complaining about petrol prices. Oh, it's gone up by another rand a litre. without appreciating that, do you know, this time last year, the petrol price was higher than it is right now? Most people don't seem to realize that. Yes, we had big hikes in fuel prices in August and September, and so the fuel inflation rate's going to pick up. And on Wednesday, tomorrow, you're going to hear about the CPI inflation rate for September having shot back up from 4.8% to well above 5%, probably 5.4, 5.5%. And then again, everyone will say, whoa, the Reserve Bank is going to raise the interest rates as a consequence, without realizing that early next month, we could have a massive cut in petrol prices of up to 2 Rand a litre, based on the fact that the oil price had gone up to $95 a barrel last month and is now back down, went down to 84 and is now back up to 89.90. But that's enough to give us a petrol price cut, unless in the interim this whole Middle Eastern war starts erupting more dangerously and oil prices spike back upwards again. I am not a geopolitical analyst to know exactly what's going to happen, but right now the markets are relatively optimistic in believing that oil prices are not going to, that Biden and Blinken are running around the world to try and just keep the peace, to prevent Iran coming in. That's the key, actually. If Iran gets pulled into this war directly, then all bets are off. The world is going to go into a recession. Oil prices will go to well above $100 a barrel, and we're going to have a massive inflation. But in the interim, by the way, the impact of that is also central banks are going to be that much more reticent to increase interest rates further, even if higher oil prices result in higher inflation, because they don't want to put a further burden on global economic activity by raising interest rates further. So we're relatively optimistic that inflation will gradually come down. We're looking at a figure of close to 6% average for this year, declining to close to 5% average for next year, 4.8, 4.9, and then coming back down to 4.5% by 2025. That's obviously what the Reserve Bank would like to see. What's it going to do with interest rates? Obviously, it's also dependent on what the Americans do, and I'll come to that in a moment, and other countries. But for the moment, I think there's enough disinflationary pressure for the Reserve Bank not to have to increase interest rates any further. The repo rate's at 8.25%. The inflation rate is 4.8, going up to 5.5%. You're still looking at a 2.75% real interest rate. There's no need to kill this economy stone dead further, and especially with the possibility that petrol prices will come back down again next month, and we could have respite on fuel prices. The bank has expressed concern that we could have an El Nino phenomenon repeating this year, which could push up food inflation back upwards. And also, there's a shortage of chicken and eggs because of avian flu, which is pushing up those prices. But hopefully, those are not longer-term issues and can come down after that. Obviously, one of the factors that influences the rand, especially against the dollar, is what the dollar itself does. And on the expectation that globally interest rates will have to remain higher for longer, especially in the US, the dollar has been extremely strong. And that, to some extent, has exaggerated the weakness of the rand. Against the euro, I see we're back down to below 20 Rand to the euro today, and against the pound, we're back down to below 23 Rand to the pound. And I remember it wasn't so, it was some years ago, actually, that I remember going to a cricket match at the Wanderers and seeing all these pommies, England, South Africa, and thinking, geez, this is dirt cheap. It was 24 Rand to the pound at the time, 4 pence for a rand. When I studied in England, I got, you know, it was 1 Rand 40 to the pound. Yeah, long time from there. But that's a long time ago that I went to that cricket match, and the rand is still not any lower against the pound. So a lot of its weakness has been against the dollar. So let's not forget that. But no doubt there's globally a feeling that interest rates will have to remain higher for longer. Inflation is proving to be sticky, not coming down. Last week's US inflation figures proved it. All the numbers came in somewhat higher than expected. So they're not going to relent on interest rates in a hurry, but at the same time, they're not going to rush to increase them still further. Barring one, the big stumbling block is what's going to happen to this price of crude oil. As I've mentioned, look how it's come down. Now it's suddenly spiked back up again. And that depends very much on the geopolitical outcomes that we are facing. And as I mentioned, hopefully Iran seems to be holding back from getting too involved in what's happening right now. So we may be able to get away from the worst case scenario. Just to show you what's happening globally, your headline inflation rates have come down quite sharply, but your core inflation that excludes food and fuel remains quite sticky. And that is why you've got this narrative of interest rates remaining higher for longer. The other reason why, especially your longer term interest rates have remained high is because I mentioned it's not as bad as South Africa, or I compared South Africa's 70 to 80% debt to GDP ratio with the United States, which has a debt to GDP ratio of over 120%. But that's another reason why we're going to have to keep interest rates globally higher for longer. Americans are borrowing money hugely to fund all their military adventures, including the Ukraine, including now Israel. And that means that there's a huge supply of treasuries being auctioned in order to try and pay their way. And that's keeping those long-term interest rates higher. Their big fear, of course, is wage inflation. And that's where the good news lies. Because even though you've seen a slight reduction in the growth of employment in America, but notice how wage inflation has gradually come down. So that's another reason why you shouldn't expect interest rates to rise any further. But at the same time, 4.2% growth in wages is way above the 2% underlying inflation target in the US. So you're not going to get rate cuts in a hurry either. And you've seen these bond yields that I mentioned, the strain on the auctions from a huge amount of issuance. And it's not confined to the United States. There's pressure on government around the world, especially your developing countries, in Europe as well. Most countries are sitting with public debt to GDP ratios in the region of 80 to 100% or more. So you're not going to see those long-term interest rates coming down in a hurry. And what that means going forward also is that there is limited capacity for governments to borrow still more to stimulate economic activity if and when it starts slowing down next year on the back of the steep increase in interest rates that we've seen in the last few years. And especially given that your short-term interest rates have risen above long-term interest rates for some time now, that's a signal, classical signal, that an impending downturn in economic activity is going to take place next year. What do you invest in when economic activity slows down? You don't invest in stocks as much as in bonds, especially when you can now start for the first time in more than a decade earning 4-5% on those bonds. So the message that I've got is tilt your portfolios more in terms of safety, in getting a decent return on your bonds, well, a reasonable return on your bonds, not a great return. I think the days of double-digit returns in financial markets are over, especially in the United States. If you look at stock market valuations, they're way over what they really deserve to be. The yield curve has been negative for some time now. signaling, be careful, recession. The last time you had that negativity in yield curves was in 1980, and between 1981 and 1982, we had quite a severe global recession. At the same time, you're not going to see interest rates coming down in a hurry. Your real interest rates are still not back to where they were historically. So, you know, the authorities there are likely to simply sit on interest rates at current levels and wait for inflation to come down to return us to positive real interest rates there. I mentioned the public debt to GDP ratio in America. I could paint the same picture for Europe and Japan. Essentially, what's happened is governments have been borrowing more and more money. You had the crisis in the Middle East, the Gulf crisis in 1990-91, spend more money to get us out of recession. You then had the global financial crisis in 2008-09, massive spending to bail us out of recession. And the theory at that time was, don't worry, let's prevent a major economic downturn now, because if we don't do it now, then because at least we'll keep economic activity going. And in the next few years, with that economic activity, we'll generate enough taxes to bring this public debt back down to the 60% where it was previously. Keiko Lakorns, no, there was no element of bringing down that debt in the middle of the last decade. Instead, they waited till COVID came along. Whoa, another big spike in government debt. And this is not conducive to high economic growth for the next decade. I'm sorry, there's just no capacity for fiscal stimulus anymore. So under those circumstances, my tendency is to favor bonds over stocks, and also to think about investment in alternative currency, in alternative assets as a hedge against a low growth scenario. Thank you very much.